Alright, let's go ahead and get started. Before I begin to explain to you the very first accounting assumption you're going to learn, let's quickly review the whole purpose of these assumptions, and that's to provide accurate information that external users of accounting can rely on. So let's find a picture here. This one looks like a good one. So, external users. We have lenders, which are banks, shareholders, which are investors, the government, consumer groups, external auditors, customers, and we also learned earlier in the week other groups that aren't listed here. Potential customers, potential investors, unions, the list goes on and on and on. So, keep these external users in mind because, again, the purpose of these four assumptions is to make sure that when you are viewing a company's financial statements, you can trust that the information you're reading is accurate. It's true. That's why they use the word assumptions. You can assume that the information presented to you is good. Okay? Now, the first task I gave you was to fill out this table with items you own and bills you have to pay. The whole premise of this first assumption I'm going to introduce to you is the following. That regardless of the items the employees that work for a business own, or regardless of the items that the owner of the business own in his personal life, or regardless of the bills employees have that work for the company, or the bills, personal bills that the owners have of a company, these personal items have to be kept separate from the financial figures you write down on your financial statements. Okay? So that's why I highlighted this in red. This would be red flagged. An accountant would come in and they would determine whether or not the business is following this assumption. Okay? So let's go ahead and explain what this means. Alright, first assumption, business entity assumption. Under this assumption, external users can assume the following, that when they read a financial statement, the figures shown on that statement absolutely do not include the personal assets, personal debts that the owners of that business might have. In addition, when reading financial statements, external users can also assume that all the financial figures shown on that statement are related just to the business and have absolutely nothing to do with the owners, shareholders, or employees' personal lives. Let me give an example of what this looks like. Okay, on this screen there are two tables. One is incorrect and the other one is correct. So let's just assume Mr. P's Pizza. Let's take a look at this first table. This first table here, it lists that Mr. P has $100,000 in assets and $40,000 in liabilities. I'm doing pretty good. I have $60,000 more assets than liabilities. Problem though, included in the $100,000 total assets figure that I report, I included my personal sports car. That's not the delivery truck I use from Mr. P's Pizza. This is the car I use on the weekends to clown around in. That car is valued at $40,000. And what I did here is I included that in the total value of Mr. P's Pizza's assets. Okay? That's incorrect. Now look at the impact that has. On the right table, I did not include that $40,000 sports car I own in my personal life. Therefore, the value of my assets decreased from $100,000 to $60,000. Now, my financial picture doesn't look as well because I only have $20,000 more assets than debt. Okay? So think of the impact the table on the left could have on decisions made by all these external users. If I did this incorrectly, such the table on the left shows, banks are going to think I'm doing really well and they might loan me more money. Investors are going to think I'm doing really well. They might buy more shares of stock in my company. So, under the business entity assumption, you could assume that when you view a company's financial figures, the figures listed only relate to the business. They have nothing to do with the personal financial transactions that the owners or employees of the owner have in their personal lives. Okay? So if we go to yahoo.com and we select finance, and we type in Nike's ticker symbol, which is NKE, and let's pull up one of Nike's financial statements. Let's go to their balance sheet. When we look at Nike's balance sheet, whether we're a bank, an investor, a potential investor, the government, whomever, any external user, when we look at these figures, okay, let's take a look here. Property, plant, and equipment. Last year it was estimated that Nike owned $2.2 billion worth of equipment. Okay? When I read that figure, I can assume that's equipment that is just related to Nike. That has nothing to do with the personal equipment their employees have in their own lives. That has nothing to do with Mark Parker, Nike's CEO, the stuff he owns in his personal lives. Okay? So I can trust that this information is accurate to better help me make informed decisions, whether it's giving them a loan, investing more money, did they pay enough taxes, etc., etc., etc. So that's the first assumption. The business entity assumption, the things you own in your personal life and the bills you have in your personal life have nothing to do with the business, and they must exist independently of the financial figures a business lists. Okay?